Craig Chan is the head of global forex strategy at Nomura, joining us live from Singapore with his thoughts on the markets. Craig, lovely to have you on the show. What is your own sense, Craig? I want to first squarely start off with the dollar, because everybody's saying safe haven. Safe haven is not just, rates going up and the yield advantage for the currency that's supporting it, but it's also the safe haven characteristic. But what do you see playing out for the greenback in the very short term?
Yeah, I would say at least in the short term, there are some actual risks towards a slightly softer dollar. So a slightly different view. And I would say that, what this is premised on is actually a lot of the potential hawkishness from the upcoming FOMC already being in the price. There is just over 100 basis points of hikes that are priced in for this year. There's, around 25 basis points of hikes priced in for the March FOMC as well. And, on quantitative tightening, the expectation has really built up. People are saying that this could start in May or, at latest in Q3 this year. So I think a lot's in the price. And unless the Fed, or even Powell for that matter, surprise substantially on the upside, it doesn't look like there's going to be much support for a stronger dollar, at least in the very near term.
And so what sort of range would you give to the dollar, let's say from a half-year perspective, first half?
Yeah, so this is when the story changes a bit. So the very near-term view I just highlighted, that's something I think will last very short term. The reality is exactly what you mentioned, and that is, we are having the U.S. Fed moving on with relatively accelerated policy normalization. And this is a big divergence from, the European Central Bank, from the BOJ, and especially from the PBOC. So there is a divergence of policy that's going on. I think that's going to be a bit of concern in terms of, the dollar potentially strengthening a bit post-FOMC. I think that could probably last for another 1 or 2 months. But then, as you said, kind of moving out 6 months, there is actually, in my view, quite strong potential for a weaker dollar to come through. I think there can be a lot of factors that align together, slowing U.S. inflation momentum, U.S. Fed very nicely priced in terms of the hiking cycle, ECB potentially becoming a bit more hawkish, China showing increasing signs of recovery in that period. I think all of these, if these are aligned together, you could actually see quite a significant move down in the dollar. It wouldn't surprise me if you see maybe a up to 5% move lower over the coming 6 months.